The following video is going to talk about breakouts. Now, breakouts is a strategy that we use here at Stock Trade Genius to find stocks that have a high probability of going higher. We don't want to buy stocks that just pay a dividend or stocks that don't move. Our goal is to find stocks that are growing quickly and that their prices grow quickly, and we want to go along for the ride with the mutual funds. That is our goal. So let's look at this company called Priceline. You can see certain patterns that are breakout patterns that are predictable, at least more predictable than throwing a dart or just taking a guess at where you think the stock is going to go. Looking at the left side of the pattern, it starts here with a first stage base, and this is a stage after it's corrected up to 30%, and the company looks like it's going higher. Now, this to us is a risky stage base. We don't like buying first stage bases. They're hard to predict, and a lot of things can happen when stocks trade below their 200-day moving average, that black line right there. We like stocks to be above their 10-week moving average and their 40-week moving average, if you'd rather look at that. Since this is a weekly chart, let's talk about those longer periods of time moving averages, that 10-week and that 40-week moving average. So we like to buy a stock after it crosses here, this golden cross area where the 10-week crosses up through the 40-week moving average. When that happens, we find that coupled with the fact that there's already been a base has a much higher probability. So we look for the next base. Now the stock is accelerating here and it's extended from this first one. So we don't particularly love to buy in here, but then it bases. This is a consolidation or a flat base. It's a very short one. And you can see that it bases, it has a little bit of sell-off on fairly low volume. These are the volume bars that it's looking at, and that is pretty low. That means there's not a lot of selling going on, even though the price is going down. That basically means these people that made all this profit in here are finally deciding to take some of it. And the institutions believe it's going higher. So they're not selling, which is what you're seeing. And you want to be on the side of the institutions. So then it goes down below the 10-week moving average. And the week after that, it corrects on higher volume. We like that pattern. A correction of past the 50-day or the 10-week moving average on higher volume. And once it does that, you see the week after that, it's a breakout week. It goes through this pattern in this small consolidation, and it's a breakout week. Now, one of the things we don't love about this breakout week is that it's not on high volume. But for us, we get a confirmation here on pretty good volume that it's setting up to have a breakout. And sure enough, it had a breakout. Then when it had a high volume week this week right here, these 3 weeks had increasing volume, and then it had a gap up. Now, when you couple a gap up with a high volume breakout, you have an extremely predictable pattern that looks like institutions are starting to take notice of that stock. So let's look at it. It continued to go up from this breakout point, which is about $120, and then now it gapped up, and the stock goes up to a point where it has a correction, gets some profit taking. And notice that profit taking again, it's not low volume, but it's not as high as the volume on the next week. So how would you know that? You wouldn't. You'd be just happy that the fact that you're up this far from $119 to $178, and you're willing to hopefully sit through this correction. Even though it's on high volume, you kind of see what's happening next week. The next week, high volume, regaining that 10-week moving average. And once it regains, that's another good sign. Institutions look around and go, hey, let's buy some more. And look at that volume the next week after that. They bought some more, they added their positions, and that's what we want to do too. We want to do the same thing the institutions are doing. So that stock ran up again, up to a high of about $225 or so, and then it had a little bit of a correction. Now, if you'd bought it down in here at this first stage base, you wouldn't even be worried about this if you could hold it that long. But there are 5 weeks of selling, and a lot of that selling is below the 50-day or the 10-week moving average, which makes it tough to sit through that, especially when you think you might erode all your profit and do what we call a round trip or a round turn. But nonetheless, it recovered, had a higher volume week, and then continued to have higher volume weeks until it came to this point here, and then it had a low volume false breakout. It tried to go above that line, but it couldn't make it. It had a false breakout. But you know what? The institutions didn't want it to fall, so it was pretty low volume, not a lot of selling, and the week after that, it was a high volume breakout week again. And then again, if you held that stock, now you get 272 from 119. So you've more than doubled your money at this point. Now the question is, would you sit through this next stage correction? Who knows? The market corrected here possibly, or maybe it's just a sell-off or a miss in earnings. But you had to sit through several weeks or several months of down weeks, wondering if you're ever going to lose your profit. But the beautiful thing is this is called a resetting of the base. When this base here drops below the prior base. And so it reset the base. You get another golden cross here. And now this is a healthy golden cross again, because look at the volume here on this breakout. So there's a pivot here at this 234 price, high volume, and then the stock never looked back. So another consolidation here, another breakout here. And notice how these breakouts all happen pretty much on high volume. And that's where we want to be buying that stock, is in these breakouts, after these consolidations, in the safe area where if we buy it, we have a good chance of making money and less chance of losing money. And watch that stock. It came up here, had a consolidation to the almost the same point where a breakout happened, okay, just a little bit lower, and then continued to consolidate again, and again had another breakout on pretty good volume. And now the stock is trading at approximately, went to a high here of, let's see, 1,073. So if you'd bought it $119 and ridden it, you would have made about 1,000% return. The trick is having the patience to be able to sit through all of these. But if you buy it properly, you're not just taking a crapshoot, you get the breakout pattern on your side, and you get the institutions on your side, and the whole goal is to get probability on your side. And when you get all those things happening, you have a much better chance of making money over the long term.